Welcome to the Level 1 Equity Summary video series. This video is a summary of the reading on security market indices.
This slide is important because it gives an overview. Security market indices measure the value of different target markets, and the target market might be an overall market. So for example, the S&P 500 is a major index in the United States where the target market is US equities. You might also have indices that focus on particular market segments. So you might have an index that just focuses on technology companies in the United States. You can also have indices across different asset classes. You can have indices for stocks, indices for bonds, indices for commodities, and so on. The next few bullet points highlight the uses of indices. Indices are an indicator of how a given market is performing. So I just alluded to the S&P 500. If the index number is going up, then that obviously implies that the market is doing well. So the change in index value is a measure of return. It also allows you to gauge market sentiment. So as the index goes up, that means that the sentiment is bullish. If the index is going down, then the sentiment is bearish. Proxies for measuring and modeling returns. So that's another function of indices. They are proxies for systematic risk and risk-adjusted performance. They are proxies for asset classes in asset class allocation models. So the point here is that when you invest in, let's say, US stocks, then your proxy for the sort of returns or your estimate for the sort of returns you can get will be based on an index such as the S&P 500. It's a benchmark for actively managed portfolios. So if an investment manager is trying to actively manage, then you can compare his performance with the performance of the index. And finally, as a model portfolio for index funds and exchange traded funds. So an index fund might create or buy shares based on shares in the S&P 500. Also note that when we talk about the stock market index, that is just a list. So it is a list and a set of rules that a set of rules about that index, and there'll be more on that coming up. Index value is calculated on a regular basis using actual or estimated prices of constituent securities. In the S&P 500, we have 500 stocks, which are the constituent securities. For an index, we can either calculate the price return or the total return. Price return index only considers changes in price. Total return considers changes in price and income. Calculation of a single period return is similar to the calculation of a holding period return. So if in a given period your index went from 100 to 110, then the single period return is 10%. If you say that this return was 10%, then in the next period the return was 20%, then the calculation of index values over multiple periods is done by linking returns. So if we say what was the average return, that will be calculated using a geometric mean. So 1.1 into 1.2 raised to the power of 1 over 2, where 2 is the number of periods. Index construction and management. Here is the process that you go through to construct and manage an index. First, identify which target market should the index represent. If your target market is US stocks, then that obviously needs to be addressed right up front. Which securities should be selected from the target market? How much weight should be allocated to each security in the index? And I think this is the most testable aspect of the reading, because your weighting can be based on price, it can be based on market capitalization, or it could be equal weighted, and we'll talk about that. When should the index be rebalanced? And we'll talk about this also. When should the security selection and weighting decision be re-examined? So in many indices, this is re-examined every 6 months. Okay, now the various weighting mechanisms. One method which is used by the Dow Jones and the Nikkei is price weighting. The weighting on each security is determined by dividing its price by the sum of all prices. Simplistically, here is what's going on. So, beginning of period price shown over here. And just to set the context, you have an index with these three shares, A, B, and C, and you are given the beginning of period price. In price weighting, the weightage is based on the price. So, notice that C has the highest price. So, the weightage of C will be the highest. Then end of period prices are also given. So, A went from 4 to 2, so there's a 50% loss. How do you calculate the return assuming price weighting and assuming only prices? So let's not take dividends initially. The way you do this is you come up with the initial index value, which is the sum of the three prices, 20 divided by the number of constituents. So this is 6 2/3 or 6.67. What is the index value at the end? It's the sum of these 3 divided by 3, so that's 7 1/3 or 7.33. The index return as you go from here to here is 10%. If you were to calculate the total return, then the total return would be 25% because it would also include the dividend. So this is the basic point. Something that I've covered in the regular lecture but I'm not spending much time on here is how to deal with stock splits. If you have a stock split, then the divisor, which is 3 over here, that will become 4. But here I'm just covering the core concept. In equal weighted indices, we say that each stock, regardless of its price, has the same weight. And how would you calculate the return, price-based return, if this is equal weighted? You would take the return of stock A, which is minus 50%, stock B, which is 0%, and stock C, which is 40%, and then simply take the average of the three and you get minus 3.3%. Notice now that the numbers are the same between this and the previous example, but because the weighting scheme is different, your price return is different. In the previous scheme, a lot of weight went here to stock C because it had the highest price, and since that had gone up, the overall index in the previous example had a positive return. Here, since we are taking equal weights, this stock A is just as important as stock C, and stock A is actually going down by 50%. So key point is that the weighting system is extremely important. When you calculate the total return, then you have to calculate the total return including the dividend return and take the average because we are doing equal weighting. A basic question is, how can you create an equal weighted portfolio? The idea is that if you have $3,000 to invest, then you put an equal amount of money, so 1,000, 1,000, 1,000 in each stock. Market capitalization weighted index. Weight of each security is determined by dividing its market capitalization with total market capitalization. So now notice that we also need to worry about the number of shares outstanding. We did not have to worry about this in the previous examples. So one question is, what divisor must be used such that the initial index value is 1,000? When you start a market weighted index, you want some round number. If we take the sum of the market capitalizations, for A, what do we have? 500 into 4. For B, you have 100 into 6. For C, you have 100 into 10. If you multiply each of these and add up, you will get 3,600. To get 1,000, you have to divide by 3.6. Now, what is the final index value? If these are the prices at the end, and we assume that the number of shares outstanding is not changing, then at the end of the period, the total market cap of the 3 shares is 3,000. You have to divide by the same number, 3.6, and you get 833.3. So what has happened to the index? It's gone down. Your price return is minus 16. So notice how you have such a big negative number here. The reason is that A went down a lot, and the market cap of A is quite a lot. So that has a high impact and brings down the overall index return. And finally, we talk about fundamental weighting. Fundamental weighting uses measures such as book value, cash flow, revenue, earnings, and dividend to calculate the weight of each security. I've listed a whole string of fundamental factors. Typically, you will just take one. So you might say that for A, B, C, we weight based on earnings. So the company with higher earnings will have a higher weight, lower earnings will have a lower weight. In this simplistic example, I'm giving an equal weight to all three. So our return will be similar to equal weighting. If this entity had earnings of 40, then its weightage would be 2 times more than the weight of B. So that's an important point. The fundamental weighted indices have a value tilt, and I'd say just remember this fact. In the regular lecture this is explained in more detail, but the point is that if you think about market cap weighted, a stock with a very high price to book value ratio will have a higher weight because the weightage is based on market price. So if market price goes up and all else stays the same, that particular stock will have a higher weight. Whereas in fundamental weighting, if the stock price goes up, that does not change the weighting. The weighting is impacted by earnings in this particular scenario. So just remember that fundamental weighted indices have a value tilt. Pros, cons of different index weighting methods, and I think this is testable. The price method, where the weight is based on price, is simple, but the weight is arbitrary. It's just based on the stock price. Equal weighted is simple. High market cap stock is underrepresented, and this method requires frequent rebalancing. What does this mean? You put equal money in each stock, and then one stock shoots up. Your portfolio will then have a higher weightage in that, so you will need to frequently rebalance in order to ensure that you have an equal weight in every stock. Market cap securities held in proportion to their value. This is influenced by overpriced securities. So if a security is overpriced, then that security will have a higher weight. And fundamental weighting, here we have a value tilt, which is a good thing, and this does not consider market value. This also will require rebalancing. Rebalancing means adjusting weights of constituent securities. A related term is reconstitution, which means changing the constituent security. Next we come to the different types of market indices. You can have equity indices. What we are talking about here is indices where the constituents are stocks. When we talk about a broad market index, we would mean an index with lots of constituent securities. Multi-market indices would be indices where you have stocks from different markets. So for example, you might have an index that represents Asian stocks. There you would have stocks from different countries in Asia. Sector indices, you might have an index which is based on the technology sector in the United States. There obviously we would have stocks like Oracle and IBM and so on. Style indices, what we have here is indices that are either value or growth. For example, you might have indices that either represent large cap stocks or small cap stocks. So these are the two classic examples of styles. Value versus growth. Value indices would consist of stocks that largely have relatively low PE ratios or relatively low price to book value ratios. Growth stocks would be stocks that are expected to grow faster, so relatively high PE ratios and also relatively high price to book ratios. Large cap, medium cap, small cap, this refers to the size of the stocks in terms of market capitalization. We also have fixed income securities, and what I've highlighted here is some points that might show up on your exam. Fixed income securities are challenging to construct. We have a large number and variety of fixed income securities. Pricing data is not always available because fixed income securities are not always very liquid. Since they are not liquid, price data is not easily available. These are also not easy to replicate, because with a stock-based index, you can then create a fund with those stocks. But if you have a fixed income index where it's not easy to buy those particular constituent securities, then you cannot replicate that index. We also have commodity indices, real estate indices, and hedge fund indices. This material is also covered in alternative investments. What we are doing here is highlighting some major points. So commodity indices consist of future contracts on one or more commodities. So this is an important point. When we talk about a commodity index, the constituent isn't the commodity itself. It's typically a futures contract on the commodity. Performance of index and underlying commodity can be different. Why? Because of the fact that the index is made up of the futures contracts. It is common to have multiple indices with the same commodities but in different proportions. So you might have index A and B with the same constituents, but A is more heavily weighted in agricultural commodities, B is more heavily weighted in precious metals or energy. The weighting methods may differ, and they might have different risk-return profiles. Real estate indices represent the market for real estate securities and the market for real estate. So real estate securities are items such as REITs, real estate investment trusts. You can have appraisal indices where the prices used for the constituents are based on estimates or appraisals, not actual market price. You might have repeat sales indices or REIT indices. Hedge fund indices reflect the returns on hedge funds. Constituents determine the index. This is an important point. When you have a hedge fund index, it is the different hedge funds that choose to give their data to this entity that is publishing the hedge fund returns. So poorly performing hedge funds are less likely to report. For this reason, index returns are overstated due to survivorship bias, and actually the risk will be understated.
If you found this lecture helpful, then I'll be very grateful if you can do 3 things for me. Number 1, like this video. Number 2, like my Facebook page. And number 3, visit analystforum.com and there add my logo to your studying with profile. You can see this slide for help on how to do that. Thank you very much and good luck with your studies.